It's Thursday, the 28th of January 2021. Welcome to the Fear and Greed Business Headlines, the business news you need in just 5 minutes. I'm Sean Aylmer. Today's headlines: is the outlook for inflation as benign as authorities claim? Or is the scourge of the 20th century making a comeback? That's our main story. Plus, Australia's future fund is cashed up and ready to invest in riskier assets. The big miners' share prices take a tumble, and one sector of the property market that isn't looking so flash. Inflation, remember that? Well, it's not dead after all, though admittedly it's not exactly thriving. And that has implications for interest rates, share markets and wages. Bureau of Statistics figures released yesterday show that consumer price inflation rose at a 0.9% clip last quarter, and the same amount for the full year. The biggest price rises came in tobacco, childcare, holiday travel prices and medical and hospital services. Electricity printed the biggest decline, down 7.5%. For the December quarter, underlying inflation, which strips out all the volatile items, rose 0.4%, and over the year was up 1.2%. That's still a long way below the Reserve Bank's target range of 2 to 3%, so there's no chance of the official interest rate rising anytime soon. But there are signs that market interest rates, particularly longer-term ones, might start creeping up. With booming share markets and a rising currency, there's plenty of momentum in the economy at the moment. Significantly, inflationary expectations, what people think will happen in 6 months or a year's time, have also changed. They've started creeping up. Expectations are particularly important in setting prices and wages and can have an impact on financial markets, including stocks. Also, globalization and free trade push prices down in Western economies like Australia. Clothing from Bangladesh, motor vehicles from Europe, white goods from China all become more affordable. But globalization, in large part thanks to Donald Trump, is on the retreat. What does it all mean? Well, inflation ain't a problem right now, but it's quite possible that we won't all be quite as sanguine about it in 12 months' time. If the economy keeps expanding and inflationary expectations keep rising, rates won't be too far behind. And that will provide a reason for workers to ask for wage increases and businesses to push up prices. It's not a major problem for the economy, but after decades of price stability, inflation is now a real possibility. In overseas news, the total number of coronavirus cases worldwide has passed the 100 million mark, with 2.2 million deaths. Around a quarter of the cases come from the United States, followed by India with 11% of cases and Brazil with 9%. Germany, the world's fourth largest economy and the biggest in Europe, cut its 2021 economic growth forecast overnight to 3% from 4.4%. And Microsoft said booming PC sales, growing demand for video games and an increase in the use of its cloud services pushed revenue and earnings much higher than expected in the final 3 months of 2020. But it said that there were signs of a return to more normal IT buying after nearly a year of crisis buying. Locally, Australia's sovereign investment vehicle, the Future Fund, made a 1.7% return last calendar year, with total assets reaching a record $171 billion. That's well below its target of a 6% return each year, but not bad given the COVID-19 related market sell-off. Over the past decade, the average return was 9%. Chair Peter Costello, who set up the fund when he was federal treasurer, said that governments were pumping stock markets by keeping official interest rates at record low levels. Technology companies were particularly frothy, he said, and day traders could end up losing out when professional investors start selling unprofitable tech companies. He said there will be a correction and fallout at some point. Notwithstanding the comments, the Future Fund has increased its risk appetite. According to Chief Executive Officer Raphael Arndt, it has cash on hand and it's ready to invest as opportunities arise. Tough day in the office for Fortescue Metals. Its share price fell 6.4% yesterday on fears of lower Chinese demand for iron ore. BHP and Rio Tinto also suffered, at least in share price terms, both down more than 3%. There are concerns that Beijing will cut steel production as part of its next 5-year plan. At the other end of the spectrum is Wesfarmers, which has broken through the $55 a share mark for the first time. The National Australia Bank December Business Survey showed conditions hit their highest level in more than 2 years during December, but business confidence tumbled. It seems that while the strong employment market was driving business conditions, the reinstatement of some lockdowns hurt sentiment. One financial market that didn't do so well in 2020 was the apartment rental market, and specifically inner-city apartments. CoreLogic figures show that across the capital cities, house rents were up 3.3% collectively, but apartment rents were down 4.6%. Part of that was attributable to a lack of immigration as a result of COVID-19. And Andrew Forrest, the billionaire founder and largest shareholder in Fortescue Metals, who late last year bought RM Williams for $190 million, now wants to bring back the 35% of production done overseas. He said he'll spend whatever it takes to get the manufacturing back in Australia. The group reported a record sales month in December. That's the Fear and Greed business headlines for today. There's more on all of these stories in today's full Fear and Greed podcast, as well as an interview with economist and author Jason Murphy about the rise of Bitcoin. I'm Sean Aylmer. Enjoy your day.